Hey everybody, Jack Leckie, Mortgage Advisor here, and welcome to episode 5 of Mortgage Myths. In this video series, I'm going over popular myths that I've heard in my years in the mortgage industry, said by fellow lenders, by realtors, and even a lot of borrowers. So let's get started. Mortgage myth number 5. You can't buy a home if you have student loan debt. Now, I know that a lot of people are struggling with student loan debt, especially in the millennial generation that is just now coming into the age where they're looking to buy their first home, and they are coming across this issue more and more often as more millennials have a college education than ever before, and many of them had to pay for it themselves using student loans. So this is an epidemic in our country right now. And many millennial first-time home buyers feel like this guy, that this student loan debt is a weight that they have to drag along with them everywhere they go, and they feel like it's insurmountable. But I am here to tell you today that that is not the case. So first off, let's answer a question. Why are student loans so important to a mortgage company to begin with? And the answer is student loans are typically the largest payment included in your DTI ratio. Now you ask, Jack, what's DTI? Well, I'm glad you asked. Come with me on our rabbit trail as we explore DTI. DTI stands for debt to income ratio. This is a calculation that all lenders use for every kind of loan to evaluate your ability to repay a loan. And it is a calculation that involves all your existing monthly debts plus your new mortgage payment divided by your gross monthly income. Let's get into this in a little more detail. Existing debt, what's included? It's all your debts. Anything that shows up on your credit report as a debt. Car loans, credit card minimum payments. If you pay extra, that's up to you. We're only looking at the minimum payment here. Student loan payments, personal loan payments. Some things that are not included is rent, utilities, insurance, phone bills, anything like that. It is only debts that you have that show up on your credit report. Your new mortgage payment. It is the PITI, as we call it, principal, interest, taxes, and insurance. Also your PMI and any HOA dues, which HOA dues are not added to your mortgage payment, but they are included in your debt to income ratio. And then finally, your gross monthly income. Now, this is your gross income before any deductions, before your 401k, before your federal tax withholding, or anything else that you have deducted from your paycheck. This is before any of those deductions. It is gross income. And it is expressed as a monthly total. Well, let's look at a scenario here. Aaron and Fiona want to buy a house, and they are calculating their debt to income ratio to see if they can qualify. They have a $200 car loan, $150 worth of minimum payments for credit cards, $300 in student loan payments, $100 personal loan payments. We're not including their rent, utilities, insurance, or anything else, so their grand total is $750 a month for total existing debt. The house they want to buy, the mortgage that they're looking at, has a total of $1,198.67 for a mortgage payment. That's about $760 principal and interest payment, $187 taxes, $125 insurance, $110 worth of PMI, and $1,667 HOA dues. Now that's actually pretty common for HOA dues because it's usually an annual total. This scenario, I'm using a $200 homeowners association fee due annually. We express that as a monthly amount by dividing it by 12, and we get $1,667. So there you go. Their total monthly housing payment is $1,198.67. Their total monthly income, so Aaron makes $28.75 an hour and works 40 hours a week. So the first thing we do here is we take his monthly or his hourly rate times 40 hours a week, and we get $1,150 an hour, $1,150 a week. And then we take that times 52 weeks in a year. Now catch this, This is where a lot of people mess this up. A lot of people that I talk to try to calculate their own income and they get it wrong right here because they often try to times their weekly rate by 4. There's 4 weeks in a month. It's technically not the case. There's exactly 52 weeks in a year. And so we take that number times 52 and we get your annual pay of $59,800. And then we divide it by 12 and we get their true gross monthly income of $4,983.33. So Aaron's DTI is his debts $750 plus his new mortgage payment of $1,198.67 divided by his gross monthly income of $4,983.33. And that gives us a grand total of 39.1%, which is a fairly good debt to income ratio that will qualify him for just about any mortgage type out there, whether he's going for an FHA loan or a home ready, home possible loan or USDA or whatever. So that is DTI. Now, what about student loans? So a lot of times, many of my borrowers, when they go to apply for a mortgage, their student loans are in deferment, meaning they're not making a payment on them right now. So that means my payment's zero, right? Wrong. That is not the case. Mortgage lenders do not accept a zero monthly payment for student loan debt. Here are the different ways we can calculate student loan debt. Number one, monthly payment showing on credit report. Plain and simple. If we pull your credit and it shows that you have a monthly payment for your student loan, that's what we're going to use. Simple as that. If there is no monthly payment on the student loan or on your credit report, the next thing we look at is if you have a loan statement from your student loans that shows a payment amount, then we can use that payment in your debt to income calculation. Or if you are in an income-based repayment plan. Now, not all loan types will allow this. Some do not allow income-based repayment plans. They'll still want one of the other options instead, but some of them do. And if you are in an income-based repayment plan, they will accept that payment for your debt to income ratio. And then lastly, if none of those other options are viable, we come to this last one, percentage of balance remaining expressed as a payment. Now, the standard for years and years was 1%, meaning if you had a $40,000 student loan, that payment was calculated at $400 a month. That seems kind of high, and it is high, and that's what was keeping a lot of people from being able to buy a house with student loan debt. However, they've recently changed those guidelines, and FHA loans, USDA loans, and Freddie Mac conventional loans, or Home Possible, all will now take 0.5% of the balance of your student loans as a payment, assuming that none of these other options are available. Meaning that same $40,000 student loan now is going to be calculated at a monthly payment of $200 a month, half what it was before. So in most cases, people who have a lot of student loans, as long as they have stable employment at the same time, we can still get them into a house. We can still qualify them for a mortgage. It just depends on your specific situation. So this myth is debunked. It is not true. Your student loans are not preventing you from being able to buy a house. The real answer is, as you can see, more complicated than that. But in most cases, we can find a way to get you into a house. I hope this has been helpful for you guys. Thanks for watching. We'll see you next time.